Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We read The Economist magazine each week. They do a great job, we think. And we read Barron's. Barron's, again, I don't think it's as good as it has been over the years, that's for sure, and maybe it's just the competition. It's tough for a weekly like that, but we still get some good ideas out of Barron's, and we still like Barron's, but Economists we like better. So that's really about it, and you can see that's not a tough job. And if you do that, you'll really be stunned how much you know compared to the guy sitting next to you, your neighbor, or anybody you're trading with, your grasp of global macro. They'll talk platitudes of what's going on, the consensus, blah, 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 and you'll start to think beyond that and think of, and it's just this person's talking about their platitudes of all they know about the current news and what the news of the day is. By doing this reading, you'll start to think much deeper than that, and you'll be surprised how much it'll change the way you view the fundamentals if you do this balanced type of reading. I really can't emphasize that enough. Paralysis of analysis, be careful. Don't get too crazy. Don't read every single thing. That's why we've narrowed it down to these types of things, because we know this is good stuff. There's a lot of stuff out there. There's a lot of garbage out there, so be careful. And again, don't watch too much CNBC, because as good as those guys are on there, and as good a job I think CNBC tries to do with that format, you're going to have people that are come out that are just touting their story, that are touting their book. One guy makes just an analysis one way, the next guy makes an analysis the other way. You tend to get turned around if you watch shows like that all day. Be careful of paralysis of analysis. Stay with the quality stuff and stick to it. Keep your mind clean. Didn't talk about this too much, but intermarket analysis, intermarket visual overlay charts are very important to try and validate some of your fundamentals. Again, not required, but important. And let me explain what this chart did for us. The red is the U.S. dollar. The black is emerging market stocks. The blue is commodities. These are what we watch each day in terms of intermarket analysis. And when I say intermarket analysis, we don't get crazy with this stuff. We do these overlay charts in the morning. We compare what's going on in the S&P 500 and the euro and the dollar, what's going on in the 10-year versus the dollar. We just do these overlay charts. What's happened with oil and the dollar, they continue to move in a tight negative correlation. Gold in the U.S. dollar index, Nikkei in the yen, it's been a correlation that's been tight for a long time. So that's what we watch, and we throw these charts together. We don't even do the numbers. We don't crunch these in terms of, hey, what is the correlation? What's the R squared? What's all this and that? We do visual correlations. So if you have access to a charting system where you can overlay this stuff, this will tend to help you put some visualization to your global macro analysis in terms of money flow. And let me try and give an example of this, and I know it's not easy. U.S. dollar in red, commodities in blue, black emerging markets. U.S. dollar coming down, 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 down in that pretty vicious bear market that actually started in 2002. As you can see, these other asset classes moving up really in very tight correlation together. Commodities, emerging market stocks, you could have thrown regular stocks on here. We would have seen the same pattern. It tells you the U.S. dollar in and of itself is really the funding currency that's going on here. The weak U.S. dollar that's being thrown out around the world is driving these asset classes in a very big liquidity-driven move. So that in and of itself, which you would have gotten from your reading of the giant current account deficit growing, because the current account deficit is a function of U.S. dollar being thrown out around the world, supply of dollars, the dollars we're using to support these asset markets. In and of itself, you knew that, hey, once you just saw this correlation, once you did your reading of the U.S. dollar-based credit through those derivatives funding the global economy, if this thing changed at some point in time, if there was some dislocation and the dollar started to go higher, you would have said these asset classes are going to go lower. This money flow pattern is going to change fairly significantly on a macro global basis if something happens that changes the trend in the dollar. And you would, and again, with a little bit of analysis, you would have known that commodity currencies, Australian dollar, New Zealand dollar, Canadian dollar, South African rand, all those things tend to move up in relation with commodities. So if you only knew that about the currencies of the world, you would have said, well, if something happens to dislocate this move, then the commodity currencies could get hit very hard, and that's exactly what they did. We had the credit crunch, and people started taking money out of the world and moving it into the U.S. Treasury market, and we would see, again, a correlation with the dollar and the treasuries here, too. Hey, let's start shorting those commodity currencies. Let's start buying some ISE calls on those commodity currencies on the Australian Canadian dollar, and you can see how the commodities market just fell out of bed in the credit crunch. But then you start to think about this in those terms of those market themes we talked about. Okay, this would be what would be called those risk-averse world. The dollar's funding a lot of risky asset classes are going up. This is the risk-averse world, and all of a sudden the dollar bottoms with the credit crunch, and we have this risk bid. So this becomes the risk appetite world. This becomes the risk-averse world. Money's coming off the table out of risky asset classes and back in to the world reserve currencies, deep capital markets, which helps the dollar, and we get a risk-averse bid. That's the thematic that's playing out there. You saw that obviously in the news, and you would have seen that very early in your global macro readings if you knew a little bit more about what derivatives meant. And Carolyn Baum and Global Economic Forum would have explained all that to you, knowing that this little problem that happened, that started to rear its ugly head here in the real estate market in the U.S., which most of the analysts on CNBC came out and said, it's just a small problem in the U.S. real estate market. Nobody needs to worry. If you were reading the Global Economic Forum on a regular basis and Carolyn Baum, you would realize that any problem in a derivatives market that is interlinked globally is a problem everywhere, not just in the little corner of the U.S. real estate market. So there's where your depth of your fundamental analysis would have come into play when the guy on CNBC was saying, don't worry, and the consensus was saying, don't worry. That would allow you to position for a great trade there. That really is one of the best recent examples of our fundamental analysis paying off in a big way. Then, of course, we got a bottom in oil, started to get a bottom in commodities because China started to crank it up again. We started to see China get hot. Commodities, oil started to, put in a test and put in a bottom. Commodities market started, this isn't oil, this is emerging market stocks. Oil is part of this, but we started to see commodities in general put in the bottom. Emerging market stocks started to put in this type of bottom. China was hot. So we've got back in that risk appetite environment in the world. Money again started to flow offshore in the belief that green shoots, China, whatever, and of course what happened to the dollar, we down, and of course the dollar has come off. Commodity currencies have done well. The euro has done well in this movement in the risk appetite world. Here's where we are, of course, right now in terms of where we're going to go, and I'll give you the scenarios there. But again, in your readings, you're reading things in global, you're reading your stuff every day, and you're starting to read, hey, the China stimulus is working. Emerging markets are starting to pop. That tells you something. That tells you, again, the capital gains opportunities, again, are back offshore. People are going to come out of hiding. You would have been reading, you would have said to yourself, the credit markets are loosening up. The spreads are coming down between the risky part of the bond market and the treasury market starting to come down. Money's loosening up again. Maybe money's going to start moving offshore. It may be bad for the dollar again. It may be good for these risky type currencies, emerging market currencies, or commodity currencies, and that's exactly what it did. Again, it's not rocket science, but it's putting you in that ballpark for that move. It's a never know type thing, but that's what we're trying to do with this analysis.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.